Did you see the movie The Big Short? The Big Short?
Actually, I haven't.
You didn't see that? Yeah. They tried to explain like the 2008 mortgage crisis, what caused it, how some people made some money. And it was a little bit of a documentary fiction, you know. But the movie, I think it's a good example of where when they tell us the truth, it's to cover up a bigger lie. And so it was partial truth, the story in that movie about 2008. Because you say, what caused 2008 crisis? Derivatives, they say. Leverage, greed, all right? Mortgage debt.
Mortgages.
Yeah, and options and crazy derivatives they were using. But that's not the cause. You know, that's more of a pretext to kind of explain it to the layman. And then they might say Lehman Brothers caused it when Lehman Brothers blew up. But that's what the start was. So when we differentiate and discern start, pretext, and cause, the true cause in my mind started in 1999 with the repeal of Glass-Steagall Act. Okay?
You mentioned that.
You know the Glass-Steagall Act, right? It was that old... it was laws, like prescriptions that came out, laws that were designed after the Great Depression, the investigation, you know, in the 30s. And one of the key rules from that act is banks cannot, by law, put debt on their balance sheet as an asset. They cannot call debt reserves. Okay.
And then loan against it.
And then loan against a fractional, like, you know, next thing you know, you're levering to hell. And what happens then is let's say mortgage debt is called guaranteed. And because it's guaranteed, why is it guaranteed? Because they said real estate has not gone down in America in history. Therefore, it only goes up. So that's their logic, you know, and okay.
In theory, but, you know, how long can it go up 20% a year?
But it's only their sample size. You know, real estate is just like any asset. It rises and falls, of course. You know, during the Great Depression, real estate completely collapsed. You know, totally collapsed. You read the books called Grapes of Wrath, you know, and the family from, where were they from, Nebraska or something, or Oklahoma, and Okies? They lost their farms. They had to go. You know, and so there was no, real estate definitely can go down, especially if the financial crisis hits. So, no, it's just a faulty lie to trick people and trick the government to say American real estate is guaranteed. And therefore, we call it a AAA bond, okay?
False
and if it's AAA, then we are allowed by law now, after the repeal of Glass-Steagall, to put mortgage debt on the Lehman Brothers balance sheet and call it reserves as an asset. And so it's that loan for mortgage is the same, treated legally the same, and accounting wise, as a cash deposit. So it's like a customer comes in and gives you the bank. And what you said is, as the balance sheet rises with more debt given out to mortgage, what happens? The bank's balance sheet rises, they can lend more. So, and what do they lend for? More derivatives, more mortgage. And so it's like a cycle. And next thing you know, the balance sheet of Lehman, or a lot of those banks, was just loaded with commercial debt. And not only was it real estate debt balance sheet, so not that much cash on the balance sheet, mostly debt. Not only that, by law, the government could report it as, the banks would report the mortgages and the derivatives at full value, 100%. It's called mark to market. They would market to par. If the mortgages were going down in value because customers were defaulting or disappearing, or the whole thing got too expensive, the bank would still call that 100% valuation. Even though in reality, maybe this debt that they own on their asset side of the balance sheet called reserves is much less. So they were able to call it par, not marked to the value of the market. And so what happened is when the 2008 crisis started to hit, and the low-end borrowers of real estate, the worst loans, the most corrupt, the poorest, borrowers, purchase of a house, they would default first because they're the weakest, okay? And so as the defaults were happening in the real estate, now the bank has no choice. They have to write it down because the bond defaulted. And so basically the balance sheet of Lehman Brothers and the other banks was collapsing. Not much different than, let's say, how in It's a Wonderful Life, where the customers all line up outside and they pull their cash. It's the same idea as a bank run, but it's just the debt's falling apart. And that's why they need bailouts. They needed bailouts to survive. They didn't need bailouts and keep their jobs and keep their bonus. They didn't need bailouts because the American needed it, and that's a whole different story. But they got bankers, and so the bailouts basically pumped up their balance sheets that were collapsing because of debt. You understand? So that's how the 2008 crisis started. Hillary Clinton also did in that act, and Bill, I assume, was involved. But Goldman Sachs had a big party for her and said, you gave us student loans on a platter in 1999 because the Clinton administration made undischargeable in bankruptcy.
Yes.
Student loans. And now they go to, if I am a student and I borrow a bunch of money to go to school in some damn college that teaches me to hate the country and despise men so that I'm completely unemployable because I'm spiteful and I think the world is an awful place and turn me into a Kane thinker where everybody's out to get me and rip me off and screw me over and I've got tons of student loan debt to prove it, then I know what I'm talking about. That, if I die, my parents have to now pay off the debt.
Student loans and taxes.
Yeah, that's pretty mean. But Hillary Clinton, primarily, and the Clintons did that. And they're friends with the bankers more than anyone. Democrats are really close with the banks. Of course, they're the same people, same party, ideological part of the same party. Racially, also very connected. So, anyway, this is how 2008 happened, more or less. And so now we'll say, well, what I just described with mortgages is more or less what happened in the Great Depression. Instead of mortgage debts called bank reserves and kept on the bank balance sheet as an asset and loaned all of, now it's government debt. Back then, and now it is today, but we'll get into the future. Right now, though, or back then, 100 years ago, European commercial banks, state and local banks, and America, they would lend money to the governments. So let's say a German bank, Austrian bank, or English bank, whatever, they were filled with government loans to to keep the economy kind of going. They call it the Roaring Twenties, during the Versailles era, during the 20s. Why? It was funded by debt. They were pumping money and governments were lending like crazy and the banks were buying the debt and they were the creditors. So they often ask, who owns American debt? The American banks own a ton. European banks own a ton and have it on their balance sheet as cash. But that's the future. But right now, so Great Depression was also caused by, government debt or bonds called AAA guaranteed because, it's Germany, it'll never default, the government, And, well, of course they defaulted. Banks collapsed, But not all the banks did badly in Europe when Germany defaulted, Austria defaulted in 1931. A lot of people think that the Great Depression was caused by the stock market crash of 1929. And I also believed that for many years, but it was one of my eye-opening experiences when I found out what it wasn't the stock bubble in October, but it was European banks collapsed and the European governments defaulted. Germany went off the money standard, repudiated their debts, and so did Austria, England, France, and the government said, we're bankrupt, we're not paying any debts. And then, of course, the crisis in Europe of the defaulting country spread to America because American banks were wrapped up in German debt because it paid a little more interest. And they was like, it's safe, It's German government, it's totally safe, And next thing you know, the American banks are going gone ruined, en masse. So that was a Great Depression was also caused by sort of the same mechanism. But what's interesting is what started the Great Depression in Europe was so it wasn't the stock market collapse, but it was the government going bankrupt, the Versailles government. That's what really caused the Great Depression. But, it's interesting how it started. It started with the Austrian bank called Credit Anstalt, like in April 1931, okay? The small Austrian bank declares bankruptcy because we're so full of government debt, blah, blah, blah. The bank is a Rothschild bank, okay? And so there was a little bit of panic because if the Rothschild bank's going bankrupt, it's backed by those guys, maybe the whole system is a little bit. So that began the bank failures, which eventually led to Germany, Austria going off the silver standard, gold standard. They did, okay? But what's interesting is they, probably what this Rothschild Credit Anstalt actually did, they probably pulled all the money, took it to London, and then made a big drama that we're bankrupt so they could keep all the cash, right? And then this failure was placed in all the global newspapers. The sky is falling, the world's over, banks are failing like crazy. And then the whole thing started. The whole crisis began.
It's like dominoes falling.
Yeah, then it was like dominoes. It started with that one bank, yeah. And the media blew it up, that the system is weak, everything is full of debt, government debt, and the governments can't pay it, and next thing you know, the Great Depression's beginning. There was a funny story, too, I like to tell, is the German finance minister, right after Credit Anstalt fails, he goes in front of the Reichstag and the media, and he makes an announcement. And the German says, if we don't straighten out our bank's balance sheets in the next 100 days, Germany will declare bankruptcy, he says. Well, of course, that started a bank run, so Germany went broke 6 days later. The German guy's trying to do the right thing. He's saying, let's work together and solve our problems. I know it immediately. Germans got too honest for that kind of job. It's got to be better to get somebody like President Roosevelt. Even the day before the 1932 election, when he won, of course he won because he could blame the Great Depression on the predecessor, Herbert Hoover, and so he won. He had the media behind him. And Roosevelt even declared, like the day before the election, there's no way America will end the gold standard. No chance. What was the very first thing he did when he took office? Confiscated the gold from everybody on the gold, took the gold from the banks and replaced it with paper that's worth 50 cents on the dollar.
I think they took the gold in like March at a certain price at like, say, 20.
Yeah, some 32, 33, 22 they paid.
And then by March it was worth 50, or by September, 6 months later, it was worth 50% more.
Yeah, so basically they took half of everybody's savings and wealth and devalued the dollar so that they could pay the debts off. Who knows how they exactly did it, but they went from paper or from gold in America to paper. And that was a major crisis, the Great Depression. And so because of the Great Depression hit, governments could now switch from gold to paper. So it was a major change, And now you fast forward today, and you see governments like in London, and not America yet, but they're declaring that the economy will go now from paper to electronic. Okay.
And that's scaring people.
Yeah, and that scares people, exactly. And a lot of people don't want to give up all their rights and their money to the government. So people are not happy to hear it. But if there's a crisis, a financial crisis, then people are panicked and they will want order. and they will want safety, and they won't know what to, and they're willing to give up rights and freedoms and even lose their property because they're scared.
For safety.
So that's why, it seems like the stars are aligning today, like the Great Depression. So let's say right now it's 2025, almost 2026? Well, that would be equivalent to, let's say, 2027 in a Great Depression era. Well, at this time, in 1927, the stock market had not taken off yet. Eventually flew up to the moon in 1929, October, when it crashed. But in 1927, the stock market is very tepid, mostly bearish. People were not all going, And also, European money, though, was getting scared. Like today, European money was starting to worry. Versailles, people saw some dangers. They were worried. They saw the debt. So money started to shift to America in 1927, 28. Plus, America had new technologies at that time that were expanding the economy. So they had, electric, gas. They had food production and food transport. Automobiles, airplanes were just starting. So we had some new economies. And European money was coming, and that propelled the stock market much higher until it bubbled. And so we're seeing about the same situation today. And with AI now, it's going to bring a revolutionary change to the whole economy.
That's going to be a big one.
Yeah. So we're also now seeing, like in 1927, 28, AI could drive the stock market to the roof for no other reason than that as companies, especially the big companies, adopt AI, they're laying off workers, and so they're going to report short-term earnings are going to be really good because they don't have to pay workers. They're expensive. And insurance and all the stuff that goes with a worker and taxes and employees. Well, so we should see companies promote wonderful earnings over the next couple of years. Of course, the underlying economy was going to be very weak. People lose their jobs and they don't have money and they have to borrow and all this. But we should see then money coming to America with AI. We should see the stock market take off. Okay.
Well, because I heard they're gonna spend so much money for AI infrastructure, so many.
For example,
hundreds of billions, if not even a couple of $1 trillion, but it's not going to affect most Americans initially. Until.
But it helps. It gives jobs and stuff temporary.
Yes, temporary.
And it's debt-driven expansion. And what we saw in Versailles is the balance sheets were exploding in Europe because of the war still paying. And there were many reasons, and they had debt already. And so we're seeing that today now, that the balance sheets of all our governments are blowing up like crazy. In Europe, particularly because of immigration. It's very costly. And Ukraine war. And so we're seeing the balance sheets also expanding, and the bank governments are spending money like mad and borrowing like mad. So we see a lot of similarities between today and like a year, 2 years before the stock bubble. So it's a good chance we will see a bubble. And then when you see a bubble, you got to see a crash. And when you see a crash, there's also a crisis. And with the crisis, it gives a chance to usher in a new system. And people now are really worried and angry, and they don't want to give up after money and all their rights. But, bring a crisis. Then it's possible. Because people need order when there's chaos. A lot of people welcome it. And so we could see that also very similar to the Great Depression era. So the stars seem to be aligning. Okay? We should be seeing that. Now, what is going to happen? Well, let's assume we see a bubble over the next 2 years. If we follow the Great Depression script, like a sequel to a movie, let's say, and the producers are working on it, what we will see is the stock market taking off, money coming from Europe, new technologies, AI, bringing the economy pretty stable, good earnings, blah, blah, blah. Stock bubble over the next year and a half. Then, before the election in 2028, before should be the crash, before the election, just like Roosevelt was able to win the election and change the whole system. So they wouldn't have the crisis after if they cause it. Well, what do you mean they cause a crisis? No, it's just like credit onstall. One crappy bank has to go bankrupt somewhere and ruined, and they blow it up, and all the global newspapers, they all work together and collude now anyway. And so then they blow it up, the whole system is collapsed. So you remember when those 2 or 3 banks in California defaulted a few years ago? I forget what they're called. Yeah, I don't remember.
They were tech banks.
They were tech banks, they said, but the media. But first, what I remember is Janet Yellen, Treasury Secretary. I think she's dual citizen too. I'm not sure, but she declared on Friday, "There's no way we're going to bail out these banks. No chance." And then on Monday, completely did a reversal. Okay, so somebody told her, change your tune. Yeah, she took it to the woodshed, right? And then also, they did a complete reversal. And then also the media played it off like, oh, these are just some corrupt CEOs that don't know what they're doing. The banks are incompetent. They were over-levered. They were stealing. They don't know what they're doing. But the media had played it the opposite, like credit onstall, and the whole world is ending. The crisis would have spread. That's what had happened. And then on Monday, I know Janet Yellen and Treasury reversed, and they bailed out the banks. Not everything, but they bailed it out. And they changed the mark-to-market rules, so now government debt on the balance sheet is now at par, 100%, even if it's worth less and less. How does it get less and less? Interest rate drives, especially long-term debts.
Oh, so even if it's a values, they mark it at par?
Yeah, they call it 100% value. So we won't see, the balance sheet could be a lot less than what they're saying in reality, but we won't know until there's defaults.
What a shame.
Like in 2008. We're only going to know when the mortgages finally default. Then they have no choice, but they have to write it off. And then balance sheets are going to bleed like crazy. Like I know a Chicago bank, I believe they have 80% of their balance sheet is government debt. And now it's safe now, it's guaranteed now, but who believes America's going to even last a few more years right now without restructuring? No way, who believes that? Not to mention Europe and Japan.
Our GDP barely covers the interest.
Yeah, 30% of our taxes goes to interest on the national debt. 30% of our federal taxes, which is like paying off the minimum payment on the credit card. And that money all leaves America in the foreign, like global Democrats' hands, pockets, 30%. And it's taking off, like you said, they're monetizing the debts because they can't really borrow so easily. So what we're going to see is probably Europe starting to crash. America will go last because it's the strongest country, biggest economy. The weakest go first, that's the way it works. And then who will do bad is like commercial banks will do terrible, like Bank of America and the Chicago Bank, and other banks like that, because their balance sheet's mostly government debt. So they'll go broke and disappear. But Goldman Sachs and JP Morgan, like in the Great Depression era, those are international trading banks, investment banks. Those banks like that, those two, they can go short US or short European debt. So they can load up and actually do quite well when shit hits the fan. And that's what happened in Europe, Versailles Europe, because I know French banks were loaded with shorts. So they kind of wanted Austria to go broke.